Hello, and welcome to the 2015 CFO Virtual Event, Insights on Driving Growth. My name is Danielle Azara with Argyle Executive Forum, and it's great to have so many of you joining us today. I just have a few quick administrative details to share with you, and then I'm going to turn things over to our speakers. First, I would like to thank KPMG and Workday for their participation with today's event. They've been a wonderful thought leadership partner to Argyle and are committed to providing you with valuable content and a great overall experience. So thank you to Workday and KPMG. I'd welcome you to stay connected during today's event. So for those of you that are active tweeters, you can use the hashtag ArgyleCFO to participate in the conversation online. You can follow us on Twitter at ArgyleExecForum, and be sure to join our LinkedIn group, appropriately titled Argyle Executive Forum Chief Financial Officer Membership. A quick note on content for today. We are very proud and protective of our high standards in ensuring the neutrality and value of the content you're going to hear. So we ask for your support to ensure you receive a set of balanced and neutral viewpoints on each of the issues covered, and ask that speakers, members, and partners ensure Argyle's content neutrality guidelines are followed, and we appreciate everyone's respect for our policy. We'd also welcome you to send your comments on today's virtual event to feedback@argyleforum.com. We thank you in advance for your candid feedback, as it helps to make sure that we are always improving your experience. We also have a number of upcoming in-person forums that may be of interest to you. We're starting the year in San Francisco on January 20th. And then we're going to be in Chicago in March, in Atlanta in April, and then a few events later in the year. And finally, to submit a question at any point during the discussion, you can type it in the Q&A section of the interface. Following the panel discussion, we will set aside time for these questions. So I'd now like to introduce Keith Mattioli. He's the Principal IT Advisory with KPMG. We're pleased to have Keith with us to deliver opening remarks. Welcome, Keith. Over to you.
Thank you very much, Danielle. And let me just kind of check real quick on what slide we are on. I think I may be having a bit of a technical difficulty here, and I want to make sure that we're advancing these slides appropriately. Are we, if somebody can tell me in the chat if we're on the CEO Outlook slide with the KPMG logo on it?
We are right now.
Okay, so they are advancing when I'm working. Great. So hopefully we won't have too many technical difficulties here. So thank you, everybody, for joining. And again, thanks to Argyle for helping us pull this all together. We're going to spend a little time today setting up some context based on KPMG's CEO survey. We do a global survey of CEOs every year. We've done it for the past few years. So we're going to use some of the content from that, some of the output from that, to really tee up a very interesting panel discussion with 4 panelists. So it's one thing to see data from CEOs. It's one thing to do some analysis and insights relative to that. It's another to hear what companies are actually doing based on some of those. So we've got a good cross-section, I think, of individuals and companies on our panel that will allow us to make that real. What are they actually doing to address some of these challenges, to address some of these opportunities? So a little bit of background on the CEO survey itself. So KPMG did this in partnership with Forbes. We did it a little bit earlier this year, so through the April-May period of 2015, which is important context when you think about some of the things that are going on in the economy and whatnot. We talked to over 1,200 CEOs, 400 in the U.S. and 878, a very specific number, across a number of countries, and a great cross-section from an industry perspective as well. So ranging from, high growth, likes to run with scissors technology types of companies, to highly regulated industries such as healthcare and financial services. And our focus was really on looking forward on that 1 to 3 year time horizon, focusing on growth, corporate strategy, risk that's out there. Growth and risk are 2 of the key topics that we'll talk about in detail here. We're not going to go through the full CEO survey results, but certainly we can point you to where you can get that full report from KPMG. And again, from a revenue perspective, a good cross-section of middle market to large global enterprises. And a predominant, almost 3/4 of the companies we talk to are public. So a good smattering of privately held companies that provide a little different perspective. And we went beyond just the data itself and actually talked to a handful of CEOs to really get some insights on what they think, what they see in the marketplace to really add some insights to the actual data that we saw. So let's jump into things here a little bit. I think this does a great job in kind of 2 sentences of summing up the sentiments of what's on CEOs' minds. Everybody understands there's a challenging environment, but they're not letting that hold them back. They are very predominantly focused on aggressive growth, with geographic expansion as one of the top priorities, but also looking at continuing inorganic growth. And we'll dive into some data associated to that. One of the interesting metrics was, about 2/3 of the CEOs said they're optimistic about their future growth, about their 3-year prospects. So in looking forward, 12 months versus 3 years was a key indicator. And thinking about that optimism in the context of a continued tough operating environment that we're all in, increasing and intense regulatory environment that adds complexity, but also changing customer demands. One of the interesting stats that we'll talk about towards the end is how customer demand is really driving companies to transform, to address new competition, new products, and probably more importantly, changing consumer dynamics. You think about how millennials buy and purchase versus how baby boomers have done that traditionally. There's a significant change when looking at the customer. So one of the key questions that we started off with was looking at that balance of growth versus operational efficiency, and looking at this from 2014 into 2015. So if you think in terms of what this data tells us, we've been in an economic recovery for, maybe 7 years now. So we've been at that for quite a while. And companies have spent a lot of time cutting costs, a lot of times getting more and more efficient. What we're seeing is now's the time to take advantage of those efficiencies. You can only drive so much cost out of the organization before you need to start focusing on the top line. So 95% of companies are focused on growth, which is a significant number. And think about that 95% in the context of what I just mentioned. 2/3 are optimistic about 1 to 3 years. Well, that means 1/3 are less optimistic or less confident, yet they're still looking at growth in the marketplace. Some of the keys that third who were less optimistic were focused on was that long recovery cycle, concerns about that, but there's also organizations that are being penalized by the strong dollar. You think about large multinational companies that are out there, the strength of the dollar does impact those profits for some of them. So again, balancing the 2/3 versus 1/3 who are optimistic versus less confident, but significant percentage of individuals that are focusing in on growth versus operational efficiencies. And that's really kind of a key driver for a lot of the conversation around how are they going to go about doing that. So growth, great. Am I looking at incremental growth? 3, 5, 6%? Am I looking at growing at the standard rate of GDP, or am I looking at doing something a little bit different? And the interesting, I think, dynamic here from the survey result in looking at U.S. versus global, while overall, from a U.S. perspective, a significant percentage, 73, are very aggressively focused on growth. And these are companies that have already exhausted, incremental growth opportunities that they've had by expanding into adjacent areas, to their geographies, product categories, channels. Really need to look at doing significant change to accelerate this aggressive growth. And I think we see at a global level lagging a little bit. So the recovery in Europe, the recovery in APAC is lagging a little bit of what's happened in the U.S. So it'd be interesting to see in 2016 how that global perspective shifts around this. But predominantly what they've talked about around this aggressive growth is in expanding their capabilities, right, evolving their business models to get into new markets, reach new customers, and introduce new products. So again, it's not just incremental growth of more of what I'm doing today. It's adding more capabilities, adding more products into what I'm already doing today. And some keys that we heard from the CEOs and the ability to do that are having robust innovation capabilities within the firm, right? So, that's organic and inorganic from a product, but also the use of data and analytics. The key thing is really having the ability to make some strategic decisions of, do I build it myself? Do I buy it? Do I divest it? And we've really started to see organizations that are very focused on taking an analytical approach to looking at how they make those sorts of decisions. So how do you balance this out with risk? One of the key things as we talk about organizations that are in an aggressive growth mode is you can't just run out there and throw money at things. You need to be thinking in terms of, what is my risk appetite? What is my risk profile? And one of the key outcomes as we talked with these CEOs about relating their risk profile to their growth strategy, again, 95% aggressive growth that are out there, but look at the balance of CEOs that think they're taking the right amount of risk versus not enough risk. So, a significant, a majority, 54%, still feel that they're not taking enough risk. They're not looking at different opportunities that are in the marketplace. And part of that is due to not having robust enough risk management processes in place so that they can really look at understanding what that appetite is. If one of the things that we're kind of fond of saying, if you haven't polished up your risk management processes to a sophisticated level, it doesn't really allow you to assess your risk appetite, and it's almost impossible to answer the question of, am I taking too much or too little risk? So being able to have that balance of risk management coupled with that aggressive growth was really a key insight that are allowing these CEOs to increase their risk appetite, to go and take more risk, but do it in a manageable way, do it in a way that they can understand what the potential impacts are to their growth and to their organization. So thinking in terms of organic versus inorganic growth, what we saw in prior years, 2014 specifically, and it fits in with the model of being very internally focused, operational efficiencies. A majority of organizations were very focused on organic growth in 2015, not very focused on inorganic growth, 5%. And so if you look at the jump to 2015, while most companies, there's still a predominant number of companies that are focused on organic growth, a significant jump in that inorganic perspective. So from less than 5% in 2014 to 29% is a significant growth. And some of the drivers that we've heard from organizations is the consumer isn't showing up. The competition for the customer with new products and new services that are out there are aggressive. So it's difficult to add new customers into my existing product set. I need to expand into new products. I need to expand into new markets in order to add customers, add revenue, into my organization. And that, the economic growth, right, the variability associated with that, with limited customer spending, inorganic growth, really seems to be the answer for many of these organizations as they talk about hitting those aggressive growth strategies. So we talked about that 1 to 3 year cycle of being able to look at my optimism over the long haul. So if you think about what organizations are doing to change their capital structure, to look for opportunities that are out there, I think the interesting metric, if you think about inorganic growth and the optimism over 3 years versus what companies are doing in a 12-month, that's really the definition of optimism, we think, for CEOs. They're looking at making some inorganic bets. They're optimistic over 3 years. That is a good sign of their optimism around that growth, and couples with that 2/3, right, that are being optimistic about what is going on in the marketplace. But one of the key things that we found was a focus on, getting your financial house in order. So if you look at where companies are focused, over 12 months versus 3 years, companies are trying to get that financial house in order today, so they are positioned effectively to make some of those strategic decisions on, do I build, do I buy, do I divest? And I think some of the data that came out of that conversation is very telling to position myself today, financial and restructuring, so that I can continue to be aggressive and more acquisitive over the next 3-year horizon. So again, a great indicator of the optimism that is in the marketplace. So taking a look at an international view of how companies are planning on fueling some of this growth, where they're going to put their capital in the next 3 years. So again, thinking in terms of that optimism, thinking in terms of the 95% that are looking at aggressive growth, where are they actually putting their dollars? And one of the key areas, no surprise, is around geographic expansion. So again, I need to get my products to new customers that I haven't had access to before, or I need to get new products out there in the marketplace to the customers I have. So, geographic expansion for U.S. CEOs was by far the predominant focus area for these folks. And not to say that that's easy. Right? There's many organizations that, think about the Chinese market, for instance, and the size of that. Not an easy market to get into. So, making some decisions on, do I go it alone? Do I do a joint venture? What are some other ways of making sure that I can actually get into a particular market and get into it effectively? The advertising and marketing, I think, is a good indicator. You think in terms of what I talked about earlier around customer loyalty. So continuing to get out in front of the customer, continuing to market to those individuals. So you could probably call this brand protection, if you will, or protecting the customers that I have and looking to expand those customers. But, an interesting perspective when you think about the top 5 of investment areas. The one that stands out for me, and while it's the bottom of the list, still almost 30% are focused on the employee. So we all talk a lot about talent management and having the right talent in the organization. So again, think in terms of 95% aggressive growth. I'm going to get bigger. I'm going to get more complex. I'm going to expand into new geographic markets. Do I have the right people on board to actually support that aggressive growth? Whether I need to hire people, whether I need to promote the people that are within my organization. So seeing that companies are focused on talent management is a great sign, right, to couple with that ability to grow. Without that right leadership, without the right individuals in place, my growth is going to be stunted. I'm not going to be able to do that effectively. And this is one of the topics that we'll talk about a little bit with our panel that I think is very interesting around what they're doing to manage their growth, and specifically around the talent management of, am I hiring it? Am I creating it myself? So we'll dive into that one specifically here as we get into our panel discussion in a few minutes. So we've talked a little bit about customer demand. So the customer is king is, a bit of a cliche, I suppose. But companies have learned, especially over the last 7 or so years of the recovery, that they need to continually evolve to address the changing business environment, new competition, right? The ability to get into a market is easier today than it's ever been, disruptive technology that's out there. And that changing consumer demand is really a key driver associated to it. It was interesting. One of the questions that we had asked the CEOs was really around how they are looking at transformation. So while that customer demand is driving transformation within organizations, am I looking at that transformation at a functional level or at an enterprise level? And 57% of the CEOs said that when they look at transformation, whether it's driven by customer demand or the expanding global environment or industry consolidation, they're looking at it at the enterprise level. So they're not just taking a functional view and saying, I need to fix finance or manufacturing or supply chain. They're really looking at it from an enterprise level, which, again, is a great sign around optimism, a great sign around the ability to fuel the growth that they have out there. And I think that's one of the key things, again, is, customer demand is really the key driver for this transformation. So, kind of ties directly into, the revenue, the growth, the top line growth side of the equation. So diving into, we dove a little bit more into the customer loyalty side. So I kind of mentioned this a couple of times today, and this is really the telling data point associated to that. If you think about 95% are concerned, either extremely or somewhat concerned about customer loyalty. So again, looking at that as the driver for transformation, as we just mentioned, looking at that as kind of a key indicator of what markets do I want to get into, what geographies, where do I want to spend my money. It's very interesting to see that level of concern associated to being able to retain the customers that they have. And everybody's well aware of the costs to retain a client versus to find a new client are significant. So making these sorts of investments for companies is a key to the success associated to that growth. So what are they thinking in terms of some of the headwinds, right? What are some of the things that are impacting CEOs and their ability to grow? The global economic growth certainly is top of mind for everybody. I think that's kind of an obvious one. But the regulatory environment, if you look at the amount of regulation, certainly from a U.S. perspective, I think I was looking at some statistics that said, 1 in 3 jobs in the U.S. requires some sort of license, where 20, 30 years ago, that number was more like 1 in 20. So, the amount of regulation that's out there isn't just, the financial marketplace in looking at, too big to fail, et cetera, but it really trickles down throughout. So there's a lot of obstacles associated to the regulatory environment. And the key thing here is really the companies who are positioned to react to that changing regulatory environment have a strategic advantage. So the less time, the less money, the less effort I can spend dealing with regulatory issues, the more time, the more effort, the more money I can focus on important things, right? Regulatory is a keep the lights on, don't get thrown in jail sort of thing, not really helping me with a top line. So the better I can be from an efficiency perspective and address those two issues, the better I am able to focus on my aggressive growth plans. So interesting to see those two, the global economic growth, the regulatory environment, really way ahead of the other issues. Disruptive technologies, always an opportunity for individuals that are out there. And if you think in terms of the U.S. view, right, this kind of couples very nicely with what we saw on the previous slide, reducing that regulatory complexity. I think one of the things that we've seen from the CEOs is, it's just more and more regulation and almost regulation for the sake of regulation within the U.S. So certainly looking to take some of that red tape out of the mix and, again, allow them to spend less time keeping the regulatory lights on and more time focused on growth. So, a significant delta between, what they're worried about in easing their ability to do business, versus global trade, right, corporate tax structure, which we've all heard a lot about with repatriating profits, et cetera. So again, looking to remove some of those obstacles that the government has put in place for individuals is really going to be a key for growth for these organizations. So thinking in terms of how do I drive this growth? What am I doing? Who's driving it? Who's taking on different roles within my organization? Predominantly, the CFO. The CFO is really at the center of understanding the risk appetite of the organization, understanding the growth strategy, and making sure the appropriate controls are in place so that they can actually manage that growth, manage it associated to the risk that's out there. And one of the things that I'm fond of saying, I won't say we, is that the CFO is really the internal-facing CEO. I mean, who better has a view of the organization of what's going on, where my costs are, where my efficiency opportunities are, as well as what I'm doing from a growth perspective and balancing those out. So, very interesting to kind of continually see the CFO taking on more and more responsibility. We've seen that within many organizations. Some of the panelists will talk a little bit about, their organization structures and what they're doing along those lines. But again, interesting to see the CFO really taking on that internal CEO view of the world, the CEO really focused on that external view. And again, thinking in terms of growth, thinking in terms of inorganic, getting into new markets, right? The CFO is the individual providing the information around what can we do, what's out there. The CEO is out there, kind of making it happen, so to speak. So, very interesting to see the CFO continue to take on a broader and broader role within the organization. So that's just a little bit from the CEO survey. And I'm not sure, Danielle, if we actually have the URL for the full study that's out here on the slides. That's probably something that we can shoot out to the individuals if we haven't included it on one of the slides. But, there's a nice little write-up on the KPMG website that you can go to. It's actually kpmg.com/US/CEO Outlook if you want to jot that down and run out there. So as I said, that was really to provide a little bit of context for our panel discussion. So what we're going to take a little time here with our panel and do is kind of dive into a few topics. Growth strategies and some of the challenges associated to that, how they're managing risk, talent management in this environment. Do I have the right talent to lead as I grow? And then a little bit about some of the market disruptors that are out there. So let me get our panelists to introduce themselves so everybody gets a little bit of perspective of who we're going to have with us today and the context for that. So Robin, would you like to start us off?
Certainly. This is Robin Cisco. I'm Senior Vice President and Chief Accounting Officer at Workday, and I have responsibility for all of the accounting and accounting operations and financial reporting.
Phil?
This is Phil Kreider. I head up the finance function, and including payroll at USIC LLC. USIC is the leading provider of underground utility locating services in North America. So if I can put this into English for all of you, when you drive around town and you see the paint on the ground and you see the flags on the ground marking the various utilities, that's us. Our goal is to keep any of that from blowing up or getting turned off or getting disrupted.
Great. David?
Yes, I'm David Weems. I'm Senior Vice President and Chief Operating Officer for First Technology Services, which is the technology operating arm for First Financial Bankshares and First Financial Bank. And I am responsible for all of the financial aspects of the technology division, and as well as operational efficiencies, and ensure that we're poised to keep pace with First Financial's growth. And so First Financial is a regional banking organization, banking holding company of about $6.5 billion in assets currently. So my role is not only financial but also operational.
Great. And Raymond?
And my name is Raymond Castonguay. I'm Senior Vice President Finance at Morneau Shepell. Morneau Shepell is a publicly traded company in Canada. We provide pension consulting, pension and benefit outsourcing, employee assistance program, and absence management solution in Canada and the U.S. At Morneau, I'm responsible for finance shared service, tax treasury, finance and the HR systems, external reporting, and I'm also responsible for strategy for one of our fastest growing business units.
Great. Thanks. So you see a great kind of cross-section of technology and high growth, regulated industries, organizations with very consistent growth over long periods of time. So a great kind of cross-section here for our panel. So as I said when I teed it up, the survey results are interesting, right? Get it at a great macro level. It's easy to look at that data and make some inferences associated to it, but ultimately it's different for everybody. So what we're going to dive into here over the next 40 minutes or so is, get some insights from our panelists as to, what they really see happening from the marketplace. So if you think back to what we were talking about around, aggressive growth, right? That, 95% are focused on aggressive growth. organizations are looking to do organic, inorganic ways to grow. I know, talking about growth, Robin, Workday, great growth story, right? Startup company, about 9 years old, kind of hit the $1 billion mark, almost in record time. What have been some of the roadblocks, some of the challenges, for you guys to continue that pace of growth?
Yeah, Keith, so most of our growth is actually organic. It has been historically, and we expect that it will continue to be organic. We've done a few smaller acquisitions, 20 to 30 people, where we're mostly buying technology to embed in our product, but we have not done any acquisitions that have expanded our revenue base, for example. So primarily organic. The things we worry about, particularly as you said, we've crossed the $1 billion mark and we're looking towards the $3 to $5 billion mark. Some of the things we worry most about are communication, right? As we expand internationally, as our teams get bigger, we have more layers in our organization. How do we make sure that we keep up the communication throughout the company and across the world? And, that continues to get more and more challenging as we expand. Along with that also is how do we keep the flexibility in our process? Keith, you talked about efficiencies and growth and CEOs prioritizing between those two, but it's hard to see how you can really drive growth without continually looking at how you can be more efficient. And that, we see in terms of processes that impact all of our employees, whether it be submitting expense reports or, payroll process or benefit election processes. We have to continue to be flexible as we enter new countries with new regulations, as well as we grow. So we're trying very hard to find that difficult balance between not creating bureaucracy, but ensuring we have adequate controls for a public company of our size. And I think one of the other things that we have to really make sure that we have as we grow is the data, right? How do we have the data to be able to analyze it and figure out where should we expand next? What's the next best market for us? Is our product ready for that market? And once we do enter into a market, to be able to tell, were we successful? Did we meet our goals in that market? What SKUs are selling better than others? And what can we learn from that as we enter into even more markets as we move forward?
Great. So, a great high growth, rapid growth sort of story, and some of the things that you're doing. To some degree, you kind of had the luxury of starting from scratch, right, in building out some of this organization, as you guys kind of plan that growth. Now, Phil, USIC has taken, a little bit of a different approach. I think the foundation of creating USIC, was, a merger of two players, but, you've done both organic and inorganic growth, as USIC has grown. How has that changed the perspective of some of those challenges, instead of just a pure organic approach, as Robin talked about with Workday, more of a balanced approach across the two?
Sure, Keith. It's been a challenge to balance your resources to which direction you want to go, whether you want to go organic or inorganic. Some of the issues we have is, we protect the assets of about 90% of the Fortune 500 utility and telecommunication companies. So the targets that we have to acquire from an inorganic perspective are becoming few and far between. Our next largest competitor is about 1/4 our size. So at this point, we're looking at kind of diversifying within the utility market where we can maximize that relationship that we have with the existing utility customers and take advantage of the back office support platform that we built. So you mentioned that we were kind of the result of the combination of two companies. So part of what we did when we did that was the initial stages were upgrading, the finance, the payroll, the HR, ticket management systems, data warehousing, daily operational metrics, all of that, putting that in place so that as we went inorganic, we could bring those acquisitions in-house, bring them onto our systems, so you weren't supporting dual systems out in the inorganic space. From the organic side, which obviously is a much lower acquisition cost, but we run into things like contract terms. Our customers are obviously AT&T and some of the larger telecom companies out there, procurement policies where some of the utilities might have a policy of dual vendor policies where they got to have two different vendors at the same time. Consolidation with the industry has become an issue for us as one telecom company buys another telecom company, and we're negotiating differences in the contracts. The other issue we have is union issues within the utilities. There's still about 40% of our market sitting within the utilities. So to the positive side, as the older union forces retire, that's beginning to be outsourced. And then the last obstacle or the last challenge we have is just basically the economy, which I probably the challenge for everybody, right? As the economy goes down, we see our business shift. So housing goes down, which is a very profitable business for us. We can show up and locate something 4 or 5 times for a utility. We move more into the infrastructure side of things, and that's projects, that's roads, that's laying fiber for Google or whatever the case may be. Those are less profitable projects for us, so we have to do a little bit more review of whether we want to go into that business or not.
Great. So, a much different perspective around, how you guys grow. Some limitations, right? Certainly, you can't buy your way to growth if there's nothing out there to buy. So, Raymond, at Morneau and Chappell, you've taken kind of a more measured approach to growth, and I know you've done some significant investments in the past 5 years around, I'll call it back office process and systems. How did you go about marrying that strategy of process systems transformation with that measured growth strategy?
Yeah, well, we've been quite successful in growing our core business. As you mentioned, we're a little bit more measured in our growth aspiration between, we're fine with organic growth between 6 and 8%, and usually we supplement that growth with tuck-in acquisition, which pushes us above the 8%. I think the game changer for us was a few years ago we decided that we'd like to get to $1 billion of revenue. And once we agreed to that goal, it forced us to look at our house internally and look at our process and system and realize that unless we're willing to always throw resource at that growth, which does impact your ability to improve margins, we needed to do things differently to support that growth long term and achieve our $1 billion mark. So 4 years ago, we decided to implement an ERP system both in finance and HR. And it was a major endeavor in Canada, U.S. We've got about 4,000 employees, so you can imagine that an ERP system in a business that's time-based driven touches everyone in the business. So major change management initiative. That being said, we were successful in going live. And it's starting to now bear the fruits, and we're starting to achieve the objective, the goals we had set for ourselves in implementing an ERP application in finance and HR. We're continuing to grow. We're achieving our targets. We're on path to getting to our $1 billion in revenue. But what it gives us is a foundation infrastructure to grow while not having to throw resources at it. So we're much more productive from an HR and finance point of view. We're in the process of rolling out new module, which helps us automate, digitize, streamline our processes. And ultimately, where we want to land is that it also gives the frontline employees, our decision makers, access to information that's relevant, that's timely, and upon which they can really make the decision that's required to continue fueling the growth. So right now we're really focused on process automation and streamlining and efficiency, but ultimately where we want to shift is be able to provide the data that's required.
And then kind of dovetails nice that operational efficiency sort of view of get the house in order, get the processes, the systems, so I can actually grow. And that's one of the things we've seen in the marketplace for many organizations is those internal systems and processes that have been kludged together over the last 5, 10, 15, 20 years are now limitations to that growth, limitations to getting into new markets, doing acquisitions. And, good to hear, organizations like yourself, Workday and others kind of putting new systems in place to create some more headroom spectrum that's out there. I know, David, so similar to Morneau and Chappell at First Technology Services, right, you guys have had very consistent growth over a long period of time. What were some of the keys to doing that continued growth successfully?
Well, I think for us, one of the biggest keys is that, we're a very conservative company, so we don't take a lot of crazy risks with, with loans and things like that. So we kind of know our business model and we stay consistent to that, and so that's been very successful for us in our markets. And I think we're coming up on our 28th year of increased earnings year over year, and so we have a good mix of organic and inorganic. We do focus a lot on growing our market share in our existing markets, but we're also always looking for acquisitions in markets that make sense for us. Again, we're very conservative in those acquisitions. We're not looking just for anybody to go out and buy as far as a small regional bank or anything like that, just because they're in our market. But we're looking at what makes sense for us, what fits into our culture as an organization, and what makes sense for us in our risk profile. And so we just stay consistent with our business model. We're again, like I said, we're very conservative. We don't take any crazy risks, but at the same time we're looking looking ahead of what can we do to attract more customers, whether that's new products or whatever it may be. But behind the scenes, I think one thing that's made us successful is our efficiency. We have a long way to go in that, but we are a very efficient bank from a efficiency ratio perspective, and so that's helped us continue to be able to focus on growing as well.
Yeah, so David, maybe staying with you, thinking in terms of our second topic around striking that right balance of risk, right? As we kind of saw in the survey results, 55% thought they weren't taking enough risk, 45% thought they were taking the right. You mentioned how you guys are risk adverse, have better visibility into that. Certainly in a regulated industry, right? You get to deal with all of those requirements that are out there. How are you guys managing the balance of risk against that consistent growth strategy?
Sure, absolutely. Yeah, banking obviously is a highly regulated area, and that's one of our big pain points, obviously. So we actually recently hired a chief risk officer, started a whole new risk office just to focus on things like vendor management, overall information security risk, things like that, to help us make sure that we're focusing where we need to focus on those risk areas. We are kind of experiencing growing pains right now, going from this really small bank, a small community bank, to more of a mid-sized regional bank. And so as we grow and as we add a lot more resources, a lot more people to the organization, it's been important for us to make sure that we don't get out of that risk-averse position, that we don't get out of our conservative position, but that we continue to evaluate that risk. And so the chief risk officer position has been very key for us to keep us focused on those areas and make sure that we're not changing our business model just because of new markets or anything like that. So that's been a big key for us.
Certainly being in a regulated industry, chief risk officer in financial services, kind of a mature sort of view of risk management. I know, Raymond, you're kind of also in a regulated industry as you look at that. Are you guys taking similar approaches to how you're managing risk to balance, to get that right balance of risk versus growth within your industry?
Yeah, I think so. Our company was started by an entrepreneur in the late 60s. So as you can imagine, growing revenue, growing the business is definitely part of our DNA. At the same time, he didn't want to bet the house at every corner. So having that balance between growth and taking risk risk-taking, and is definitely part of our overall DNA at Morneau Shepell. That being said, as I mentioned, we've set an objective of getting to $1 billion in revenue, and I think that forced us to look at how we're managing revenue and risk going into the future. And we've made lots of adjustments to continue balancing that revenue and that growth and risk. Some of the changes we've made in recent years is, for example, aligning the finance resource with the business so that we're there on the front line supporting decision making. As I've mentioned, implementing the ERP system so that the back office, the infrastructure is solid and providing reliable data to the decision makers. But in addition, we've started looking at innovation in lenses. So lens 1 is this year and next year. Lens 2 is in the 2 to 3 years time frame, and lens 3 is really breakthrough technology that might impact our business, let's say in 2020. And that's really also starting to shape our thinking around balancing growth and revenue. And in addition, we've looked at how we're supporting the inorganic growth through establishing decision filters, decision criteria for how we are analyzing acquisitions. And that really helps us manage that risk also through looking at acquiring companies. So we've really looked at processes and ways of decision making and the back office in order to really strengthen all of these aspects of moving the business forward.
Right, so think in terms of a couple of regulated industries with nice measured incremental revenue growth, kind of other end of the spectrum, Robin, and looking at Workday, high-tech company, Silicon Valley, high growth, recently going public a couple of years ago. Risk management is probably viewed a little bit differently in the high-tech world than it is in financial services or healthcare. How is Workday integrated that risk management view into that high-growth environment?
So we don't have much regulatory risk, as you would expect. Our risk is primarily operational risk. So we have very high focus on customer satisfaction. Everybody in the company is bonused on achieving 95% customer sat. And so we take our product and service level commitments extremely seriously. And the way we monitor that operational risk, we don't have a dedicated risk organization. We look to our internal audit function to help us manage that risk. And so what they do is they do a survey of executives and talk to a lot of VP, SVP, EVP level folks in the company once a quarter and really try to nail down, what are the things on everybody's mind? What are the top risks of the business? Obviously, those change over time. They take those results and really boil it down to, what are the top 5 or 6 or 7 that we as a company need to focus on. They present that list to the board, and each item on that list has an executive sponsor who is responsible for mitigating that risk over time. And once a quarter, the board is updated on that risk, how it's progressing, and if there are any new risks that come on or others that drop off. So that's how we manage it.
Great. So a little different perspective. Interesting, though, you need to be thinking about those regulatory issues for all of your clients, however. So probably very familiar with them, even though not something that you guys need to deal with from a day-to-day perspective in running the shop over at Workday. The next topic, we talked a little bit with the survey results when we were looking at the impact areas of where organizations were focused in. And I talked a little bit about talent, right? A little bit about the focus on talent. So if you think in terms, again, of that 95% aggressive growth, the 2/3 that are optimistic about the 1 to 3 years, in order to fuel that growth, we have to have both capacity and capability, right? And we heard some great examples of operational efficiency, right, so that we can do more with less, and that certainly has been a key investment area for organizations, over the last few years. Many of the CEOs that we talk to feel that they have the right talent in place to drive that growth. that those things have been put in place to allow them to do that. So kind of curious to explore that a little bit here with our panelists to kind of talk about your view of having the right talent in place to drive that growth, whether it's incremental growth or exponential growth. And I know, Phil, we kind of talked a little bit about some of the challenges that you guys have, which are a little bit unique if you think about a lot of your people, as you mentioned, union, guys in trucks, so to speak. But ultimately, some of those folks are rising up into management. So if you look at things from a leadership level, how have you been able to kind of create and attract the right leadership talent so that you can kind of continue that growth into new markets, into new products?
Well, we've done a couple things. One, for most of our mid-level managers and above, we pretty much promote from within. Almost all of our field supervisors, our district managers, our regional managers have all started off as locators at one time or another, and it's a very, we compete with the oil industry and the construction industry depending upon what's going on in the economy. So the guy that becomes a locator or the girl that becomes a locator is kind of a unique individual. They're independent, they're self-motivated, they're very meticulous when it comes to following a process, and they got to enjoy being outside. And so that takes a very special kind of person. So we're constantly recruiting. We're counseling lower performers. The military has been a great place, great recruiting ground for us as far as that type of individual is concerned. So we would redefine the training program all the time based upon input from the employees. We pay for certification training for the employees for specialized skills, especially if they're dealing with the gas industry, gas pipelines or anything along those lines. We also provide, and this is just trying to keep the employees, because I think not just finding the right employees is important, but keeping them is just as difficult as finding the right folks. So we have employee discount programs, including discounts with all the major car dealers, legal assistance, employee assistance programs. You got to have a good medical program in these times. 401k, all that kind of thing. In addition, what we've done is we have a program in place where we identify what we call a high potential supervisor, and we have an internal program where we'll bring them in and we'll kind of go through what it would take for those individuals to become a district manager or a regional manager. So we're constantly, the old adage that, you should always be training the guy to take your job behind you so you can advance. That's what we're trying to do internally, is find those folks to move them up the ladder as we find new states to move into, or new expansion within the existing customer base. We need a new district manager, whatever the case may be. But a lot of it is internal for us as opposed to going externally. So the key for us is we're just constantly recruiting and training.
Yep, the key. And so Robin, maybe flipping over to you. We talked about Workday, high growth, employer of choice, right? Always in the top, certainly in the Bay Area, if not, nationally, of best places to work. But, with that growth, organically, as you kind of talked about, but the geographic growth as well, what are you guys doing kind of proactively to identify areas that need leadership talent, how to matriculate people up within your organization?
Yeah, Keith, so as you stated, one of our huge challenges is that we compete with talent here in the Bay Area with companies like Google and Facebook. And so we have to have ways to attract people to Workday, and we focus a lot on our culture and on being a great place to work. And that helps us attract and retain talent in this very, very tough market. One of the other things we focus on is to make sure that people, particularly in the area of product development, but really across the company, have new and interesting things to work on. A lot of our folks that we hire, they want to work on the latest technology. They want to work on the next cool thing. And so if we can give that to them, then that really goes a long way to helping us attract and retain people. We've also had to look outside of the Bay Area. So we've set up other centers where we can attract the type of talent that we need. For example, we've got a fairly significant development and customer support center in Dublin, Ireland. We've got 500 people at that site to date, and we continue to expand there. Just a huge, huge pool of talent And while we still compete with a lot of other tech companies, again, we're viewed as being a fantastic place to work over there as well. So even outside of the U.S., we have a shared service center in Salt Lake City. And so we've got to look at alternate locations because the talent pool here in the Bay Area is very, very tough. So we're doing that as well.
Great. And Raymond, you talked about the 5-year transition or transformation, putting in some new systems, right? Better visibility. How was talent or the HR side? How did that play into putting those new systems in and being able to have that sort of visibility that you talked about around the right talent in the right place?
Yeah, we, in addition to an ERP system, and again, talking about setting the foundation that supports our growth aspiration, we also put in place a leadership profile, competencies, and assessment tool, which we're running through our leadership and having those career conversation and assessing everyone's competencies against our various goals. And so that gave us some great insights in regards to the talent we currently have in the organization. I'll talk specifically to finance. In conjunction in finance, we're in the process of establishing our long-term vision for what we want to achieve for finance. How will we support the overall enterprise in achieving its growth aspiration? So having the two components, our finance vision that shows us what do we want to do when we grow up in 3 to 5 years, in addition to having insights into the talent we currently have, I think what we're realizing is that we've got great people, but they're more transactionally focused. And it's great before we had an ERP system, before we've launched all the new module and are focused on automation. They're great people focused on transactional, which is an area that we'll need less and less in the future. Whereas what we need is people that have great analytical skills, great at supporting decision making, and that's where we probably know we have a bit of a gap right now. So our challenge for 2016 is to start supplementing our bench strength with the type of individuals that we need for the future, and continuing to prune more on the transactional side. So that's going to be our challenge in 2016 and 2017. Don't have the right balance in finance to support the overall enterprise goal.
Great, but good to hear. Everybody's focused on talent management, especially from elevating our internal folks, giving them the tools, the training that they need to take on new responsibilities within the organization. So quick reminder, if you want to ask a question, just post it on the chat on the website, and the team will moderate those and pass those on to us. So we've already received a couple of questions. So I think I want to flip into answering some of the questions now, so that we get an opportunity to kind of make this a little bit more specific to what some of the folks participating in the webcast are interested in. So one of the first questions that came out, I think, is a great question. Are any new roles being established in your organization to support the modern finance organization? I think, Rob, this is probably a great one for you, given what Workday, being a young company, but also with what you guys do from a product perspective as well, and looking at how that impacts finance. What have you kind of seen around what a modern finance organization looks like, and some roles that might be a little different than a traditional view?
Yeah, so one of the things that we've done is we've created an internal team. We call them the WOW team, or Workday and Workday team, and they're somewhat, although not very much, like the kind of financial systems IT department that you would have on a legacy system where you had a group of people that support your own internal financial system. This Workday and Workday team, however, is very different from your traditional IT support team. It supports the full Workday platform, so HCM as well as financials. And this is a team not of IT people, but of practitioners, so former HR folks, former finance folks who really love the system stuff and have been trained on configuring the Workday product. And what that team helps us do in finance is uptake new features and new products as they come out from Workday. So they are the experts on what's coming. They educate my team, and we can spend time thinking about, okay, of these new features, which ones apply to us as a software company, which ones don't, which ones do we want to uptake right away, which ones may we want to wait a little before we do. How will we configure those and use them going forward? And then that team will help us with the configuration, and we'll be up and running. And what that has allowed us to do is experience continuous efficiency improvements, even as we're going through rapid growth right now. So for example, if I look back 3 years ago when we went through our IPO, the volumes through our financial system, if you look at customer invoices, supplier invoices, employee expense report, even the number of legal entities, we've tripled most of those volume metrics. We have increased our complexity because we've got almost double the sets of books that we had before. We are contracting with customers in 7 times the number of currencies we were 3 years ago. So as we've added those volumes and complexities, we've actually shortened our close and reporting cycles by 50%. Right? And so I think it's this team has really enabled my team to continuously achieve those efficiencies, and this is how we're seeing more modern finance teams operate these days.
So, David, you're in a little more, I'll call it, traditional environment, certainly been around a lot longer than Workday has. How have you seen some of the roles in finance transitioning over the last few years?
I would say that the roles in finance haven't changed a whole lot in our organization. The main areas that we see transitioning is just overall operational efficiency, business process automation, changing the way that we collaborate together as an organization. We're already pretty fast on our financial reporting model. I mean, we generally have our financial reporting done in the first week or two after the quarter end. So we have a quick turnaround time on that, a fairly small staff that takes care of all of that. So those roles haven't really changed a lot, but what we see changing is the way we collaborate together, the way we process that information internally, together. And so just the being able to continue to grow without having to grow that staff or having to grow that, or change those roles has been important for us. So that's helped drive our overall efficiency. But I would say the roles themselves haven't really changed a lot internally in our organization. I'm not saying that's not going to happen in the next, 5 years or so, but that's where we are today anyway.
Great. So another question that came in was, how are CFOs or finance partnering with other C-suite executives to drive performance and growth? So, Raymond, I know that what you had kind of talked about, certainly putting the new systems in, had an opportunity to kind of relook at process automation, et cetera. What are some of the things that you've seen for finance and the CFO to successfully partner with the business to be on that strategic side of the fence versus just the posting transaction side?
Yeah, I think the posting and the transaction is the price of entry. So you got to be brilliant at doing the hygiene stuff so that you can earn a place at the table. But what I've seen is, as I mentioned in my introduction, I'm also leading strategy for one of our business unit, and this is really how my role evolved. I was the CFO for the business unit, and really partner with the business to drive major transformation of the business. And from there, my role evolved to more the strategy. So for that business unit, we're looking at new technology acquisitions and expanding in the U.S. So I'd say clearly my role is toward strategy for that business unit and really carving out a component of the strategy of that business unit and driving it in partnership with the business, obviously, but it's really owning that component and driving it.
Great. So, Phil, the next question is really around cost cutting. What are some of the top areas that you anticipate cost cutting? I think everybody talked a little bit about some of the things that they've been doing over the last 3, 5, 7 years to do some cost cutting. Phil, what's your perspective on some of the areas that you see the potential for additional cost cutting, or perhaps not?
Sure. The areas we look at on the cost cutting side really is on the technology side. As everybody said, with the implementation of new systems, where we've seen the cost cutting from our perspective is getting away from the legacy systems of the past, looking at the newer technologies, the SaaS systems, and finding where you can cut your costs there. I think Robin said it best. Some of the new positions we have in finance are not really so much finance positions, but they're finance folks or HR folks that are monitoring the HR and finance systems to help us use them more efficiently. So our area is constantly looking at technology, whether it be data warehousing, whether it be diagnostic software for the field to determine where we need to put our locators the quickest and the fastest to prevent damages. But that's really it for us. It's all about technology.
Gotcha. And David, how about your perspective on that? I know that you've got some interesting things within your world.
Yeah, absolutely. So, being in the actual technology arm of First Financial, we're exactly what Phil was just talking about. We're looking at things like strategic sourcing. So, allowing our staff internally to focus on the strategy and allowing strategic business partners to do the day in, day out things that don't really drive strategy. They just keep the lights on. That's what we're focusing on. We're focusing on decreasing the headcount cost, the personnel cost on the technology side, and just helping us drive strategy. As well as I mentioned earlier, the operational efficiencies that we're continuing to drive through collaboration tools, through business process automation. All of that's being driven in the technology space, and so I think that goes right along with what Phil was saying. They're looking at those savings on the technology side, and so from my standpoint, how can I provide that to First Financial? How can I help drive that cost down? That's software and maintenance are two of the biggest costs that we have on the technology side, and so as we can partner with other organizations and strategically get them to help us with those things that they're good at that we're not necessarily experts at, that's where we're driving those cost-cutting measures internally in our organization.
And Robin, I'm interested in your perspective. We think in terms of newer companies with high growth, right? Probably not a lot of legacy baggage that you need to deal with from a cost-cutting perspective. But what's your perspective on maybe it's cost containment versus cost cutting? What areas are you focused on?
So for us, it's really about continually taking advantage of our increased buying volumes to get better price. So as you can imagine, when you're a small startup, you can't command good prices necessarily for everything from hardware, internal use hardware, to marketing purchases, external party spend. But as we grow and we have more volumes in those areas, as well as things like travel, then we can command better prices because we have higher volumes. So we are in a continuous cycle to renegotiate a lot of our supplier contracts to take advantage of our increased volumes, which changes every year, as you can imagine. So it's taking advantage of that is where we see our biggest cost savings over the coming years.
Great, thanks. Well, we're kind of getting to the end of our time slot here, so I want to thank our 4 panelists, Robin, Phil, David, and Raymond. Certainly appreciate you guys taking some time to participate and share your perspective on what's going on from a growth and a risk perspective. So thank you all again. And with that, I will pass it back to Danielle.
Thanks so much, Keith. Great job moderating and sending out the questions to the audience. Appreciate it. And I want to thank the audience for joining us today for this great virtual event. You will receive a link to a brief survey, so we'd really appreciate if you could share your feedback so we can always improve. And you'll also receive a follow-up email with the recording within 48 hours. So that's all for now. Enjoy the rest of your day.